you are doing exactly what majority of the inspiring traders are doing, and that is neglecting the market structure, thinking that it's too basic, it's too easy, and it's not something that we should be focused on. In reality, market structure should be the foundation of your trading system, because if you're not able to understand market structure, your break of structures, your change of characters, your market structure shift could just be a liquidity sweep. Now, you see, you need to take a step back and look at the bigger picture. Maybe it's not that you need to change your strategy. Maybe it's the perspective that needs to be changed. Instead of marking your break of structures on the higher time frames, change of characters, market structure shifts, instead, maybe you want to use market structure to identify where the liquidity is at. Because in reality, when you hop on a chart and you can't identify where the liquidity is at within the first 10 minutes, then most likely you are the liquidity. This is exactly what I'm talking about. Going on the chart right now, you might think that, you know what, that there is a break of structure and we should be looking for sells, right? Now, let's look what the price does. Okay, we created another structure, meaning that if price trades above that, it will be a change of character to you guys, market structure shift, yada, 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 and we should be looking for some sort of buys. Okay, now body closes above. For you guys, it is going to be what? A change of character, market structure shift. You'll be looking for some sort of buys, right? From any of these order blocks that you want to see. But instead, market then proceeds to do something like this that you don't have an answer for, most likely. Now, to understand these kind of moves, you need to understand where the liquidity is at. Now, newsflash, structures are basically liquidity. Liquidity are everywhere in the market. That's just the reality. Your break of structures, your change of characters, the market structure shift that you're trying to look for, they could be a liquidity sweep. How to differentiate between break of structures or liquidity sweep? Stick to the end of this video and I'll make sure that I'll change the entire perspective of the way you view your market structure. My name is Jason. I've been full-time trading for nearly 5 years, and I've been a professional technicals coach for nearly 2 years. Currently managing multi-six figures in private investors' capital while teaching hundreds and journaling hundreds of students. And today, I'm going to be exactly showing you guys why and how I mark my market structure across the time frames. So, guys, let's look at this, right? As mentioned earlier, most of us here, we just have a thought process of that being a break of structure, that being change of character. This break of structure leads us to be bearish according to the thought process. Maybe you would want to look for to sell at this order block, right? But then if you wanted to sell from this order block, that sweep there happened. Most likely you would have gotten stopped out before the price actually moves towards your direction. Okay? What I'm trying to say here is, instead of relying on break of structures, change of characters, market structure shift to identify where the direction is going, right? Instead, we're going to be changing the perspective of the way we mark our market structure and use it as a liquidity. Basically, what I'm trying to say is, we're going to mark every single structures. We're going to differentiate between the externals and internals, but instead of us trying to make it as it being break of structures, change of characters, we're going to be using them as a liquidity pools for the price to target that. Now, this is exactly what I'm talking about. Let's say right now, instead of us saying that that's a break of structure towards the downside, that's a confirmation to look for sells. The thing is, sure, we're looking for sells, but from where? From where, right? If we wanted to sell from the order block, as mentioned, you would have gotten liquidated, right? Then what is the whole thought process? If your thought process was to be like this, that, oh, that there was a change of character, you're looking for some sort of buys. Well, the buys didn't happen, unfortunately, right? Now, instead of doing so, let me show you the drill, the exact drill that I use to mark my market structure to understand it on a deeper level. Now, let's look at this one. We're going to be using a couple of tools here on TradingView. First, we're going to use the highlighter. You're going to find everything here on the tool itself. We're going to use a highlighter and we're going to use trend lines to identify our market structure and use them as a liquidity. Now, do keep in mind, Whatever I'm doing here, whatever I'm marking, these are external structures, fully focused on external structures. And at the end of the video, I'll show you why it is so important, so crucial for us to understand the difference between externals and internal structures. Now, let's say right now, at the current price, whatever we're trading is at the lowest point. Okay? What we want to see is one rejection. There you go. One rejection. Again, because again, bullish, bearish candle combined, they become structure. They're classified as one structure. Okay? Structures cannot be one candle, single candle like that. No, it should be two candles, two opposite candles, basically bearish and bullish candles. Okay? We're going to mark this low as a structure. Ask yourself, instead of marking the next one, don't go towards the next structure. Instead of going to the next, ask yourself, where did this low here come from? You want to look at the last rejection where the price rejected from. Okay? Identify the last rejection, which over at this bid, if you were to see, we had one single rejection candle there, a candle like some sort of bullish candle showing rejection. That's where this low come from. Okay? Now, what you're going to do, take your trend line, mark the highs, and mark the lows. Now, here's the thing. The whole point of me introducing this drill, I'm not just introducing this to you guys. I introduce it to my hundreds of students. From the first who just joined me as complete beginner, this is the exact drill that I tell them to do. Now, let's look at this. The whole point of us marking the structures there with Trendline is to identify the external breaks. We're not trying to identify internal structures. We're trying to identify the external structures, okay? While ignoring the internals, completely ignoring the internals. Now, let's look at this. If we play the price, you see, there's another rejection that we can mark because that's the lowest point. Again, do keep in mind, structures are supposed to be marked from wick to wick, not the body. The more precise you are with it, the better it is. Okay, so highly suggest you guys using this magnetic tool here on the left. And then you see, once you have marked this low, that's the lowest point that was created. Ask yourself, where did this low come from? Look at the last rejection or the highest point that put this low, which in this case is actually there. Now, what do you need to do? Take this previous trend line that you have drawn, mark the last two structures, the low and the highest point. There you go. You want to keep playing the price. There you go. Now look at this. The difference between what others preach and what I preach here is that most of them, they will say that you need body closure above or below to have it as to classify it as a valid break of structure, valid change of character, whatever. For me, what I'm preaching here is you don't need body closure. All you need is a slight wick closing above or below, and it is already a valid external structure. Okay? Now, let's look at this. If we were to zoom in, you will see that the wick here actually wicked above the previous external structure. That is your new valid external structure. Where did that high there come from? Not from any of these structures. Absolutely not. That high there, you want to find the lowest point that put that high, which is this low. Okay? We've marked it already. Take this trend line, mark the high there. Now you will see that over at this bit, this structure here broke the previous high. Where did this high here come from? This low. Okay? Now you have two external structures there. Mark the highest point and then mark the lowest point. There you go. Now you have two external structures. Fine. Very good. Now here's the difference though. Right? Most of you guys will classify this as a break of structure, try to look for buys, whatever. No, these are just valid liquidity pools. Even this high here, this external structure here, that's a valid liquidity pool. Okay? The more you guys watch my videos, the more you guys will understand the importance of liquidity and imbalances. Now, you're not going to see me marking the break of structures. All you see me marking is going to be the structures. Now let's look at this. There you go. All of that. Now you will start to see that the high there broke the previous high. This high did come from this low. Okay. I'm going to mark the highest point and then the lowest point. Now you'll notice here that this wick here, wick the previous high. Where did this wick here come from? The highest point that put basically that low. You want to mark the low and then the high. And you'll start to notice that this highest point here broke the previous high. Where did this one come from? It come from that low. There you go. Now you'll notice that these two here are the last two structures, last two external structures, right? Now, if you guys are thinking that what are we gonna do with this then? All of these are market structure. What are we doing with this? Here's the thing. With the whole market structure, the reason why we're marking them is to identify where the liquidity is at. If people are buying, where are they buying from? If people are selling, where are they selling from? You see what I mean? Now let's look at this. We remove all of this and you take your trend line from the low all the way to the high. Wouldn't it be too obvious that people are buying off of these trend lines instead? Making it a what? A trend line liquidity, a liquidity type that is called a trend line liquidity. Okay. Same with this one here. This one here is an external structure, which means that above this structure here, these are the liquidity pools that needs to be grabbed before the price actually deliver lower and smoke out every single buyers that are buying below this trendline liquidity. And this is exactly what we're talking about. If we were to look at it. Okay, this is exactly what I'm talking about. Let's say, for example, right now, those buyers who are buying off of this trend line just because that's a trend line, they want to buy, but instead to them, now what? It's a breakout, yeah? It's a breakout. So now they're looking for some sort of sells. Liquidity are still lying within all of this trend line. Liquidity is still lying within this external structure. Do understand? Let me just mark the liquidity here. At the external high, you have proper liquidity. All of these external structures low, you have liquidity. At that high bid there, you have a liquidity. Okay? Now, if I play the price, kind of do something like that, you will notice here that what the price did here, again, nothing is random in the market, guys. Let's look at this. What did it do? The high here, it absolutely smoked the liquidity. This low here did not completely induce all of the liquidity. What did we do? After we took all of that external structures, all of that external liquidity, we started creating more build-up liquidity, generating more build-up liquidity, bringing in, inviting in early sellers to just induce them one more time, induce as in fake out one more time, taking out the sellers that were selling from the order block, and then only the price showed the proper move. Okay, so now, fine. We have identified our external structures. Now, why is it important for us to identify the difference between internals and externals? And that is because, look, guys, here's the thing. When you're still marking your market structure and you still mark your internal structures, the problem is those internal structures are basically internal liquidities, yeah? The internal liquidities just don't have that enough power for it to drive the price, or meaning that to make the price expand towards a certain direction. Most of the time, before price makes any sort of expansion, it will induce or it will take some sort of external liquidity first before it actually expands. Not take something of an internal and then expand doesn't make a lot of sense. Okay, there is a reason why when you go on the chart, maybe you mark your liquidity pools are not working because you're marking the internal liquidities. Now, in this particular example, what are the internal liquidities? Let me show you guys this. Or what are the internal structures or liquidity? Let me show you guys this. Let me mark it with a blue color instead, blue dot. Now you'll notice that all of these red dots, these are external liquidities or external structures. External structures. You see the structure that is in the middle here, right? You have this structure, you have this structure. These two structures here, they're just internal structures, or so-called as internal liquidity. All right, now let's look at this one here, guys. Do you guys notice what the price did here before it induced all of the liquidity, like had a sharp move towards the upside? What did it do? It induced some sort of an external liquidity first, right? External structure that we mark. It's not random. Again, guys, nothing is random. Now, if you were to look internally here, we have multiple internal structures being created. That high there, internal. That high there, internal. That is internal structure. This low here as well is an internal structure. Now you see, why did the price have to induce something external, take something of an external liquidity, take more of an external liquidity to the left, then only make an expand towards the downside? Why didn't the price just take only internal liquidity? Maybe take this high and then deliver lower. You see what I'm trying to say? When you try to connect the dots, the more you try to connect the dots, the more it makes sense that the price needs external liquidity for it to expand instead of just taking something of an external liquidity and then expand. Okay? So technically speaking, internal liquidities will not cause the price to expand. It will not cause the price to reverse. What caused the price to reverse is external liquidities. Okay? So yeah, that was pretty much that for today. Make sure to trade smartly, stay patient, and I'll see you guys in the next one.